So why is the US Fed not likely to cut rates anytime soon? All you need to know. Well, when America sneezes, the world catches a cold, a saying we all have been brought up with, and cut to 2024, this is being reflected in the case of the US Fed delaying the rate cut and its ripple effect across the world. A few days back, US Fed Chair Jerome Powell signaled that the Fed is unlikely to cut interest rates anytime soon as expected and anticipated by the street. Powell's comment about the delayed rate cut made sense as US inflation in March came in at 3.5%, more than expected, as the US Fed rate target is to bring down inflation around 2%. Since the inflation print has plateaued over and above the desired inflation target, the hope of rate cuts has been dashed by the US Fed chair himself. Powell's comment that the policymakers would wait longer than previously anticipated to cut rates has not only impacted the US markets but also had a ripple effect across the global markets. But the key question is, why does the US Fed decision matter to the world? The US Federal Reserve's decisions hold immense significance not just for the US economy but for the global economy as a whole. Any missteps by the Fed can have ripple effects across international markets, leading to volatility in currencies, investment flows and asset prices. Moreover, the US dollar serves as a primary reserve currency and a benchmark for economic performance, making its movements highly influential. For developed economies, a strong US dollar may signify confidence in the US economy and global stability. However, for emerging markets, it can pose challenges such as currency depreciation, capital outflows and debt burdens. Therefore, the Fed's policy decisions must strike a delicate balance to support domestic growth while minimizing adverse effects on the global economy. But the US Fed's higher for longer, which means higher interest rates for a longer time just to tame the red-hot inflation, has also impacted the market. But how? According to the Asian Development Bank, a higher for longer interest rate scenario under which the US Federal Reserve and the European Central Bank defer anticipated rate cuts to beyond 2024 would impact emerging economies, currencies as well as growth and inflation outlooks, with India likely to see the most pronounced effects among Asian countries. What is its impact on the Indian economy? Well, the higher interest rates encourage investors to invest capital in the US, seeking higher returns on bonds and interest rate products. This strengthens the dollar. And when the interest rates are lowered, there is more availability of dollars and strengthening of the rupee, which would mean a lower import bill for India. The strengthening of the rupee is a big relief for India, as the nation imports around 80% of its total oil consumption from various countries across the world. Simply speaking, a strengthened rupee reduces India's import bill and a strong dollar increases the import bill, which in turn increases the fiscal deficit and current account deficit, which in turn again puts pressure on the Indian rupee and leads to depreciation. And a depreciating rupee is not good for the health of the economy, as this leads to capital outflow and capital flight from emerging economies like India.